Bloomberg Audio Studios. Podcasts, radio, news.
This is your weekly Washington Policy Pulse on the Balance of Power podcast. I'm Joe Mathieu. Every Monday, Bloomberg Intelligence senior policy analyst and friend of the show, Nathan Dean, shares his weekly call on upcoming catalysts in the nation's capital. Listen for the most recent and relevant policy research from our team at Bloomberg Intelligence. Now with today's installment, here's Nathan Dean.
Good morning, good afternoon, everybody. Welcome again to the Bloomberg Intelligence Washington Policy Pulse. My name is Nathan Dean. I'm a senior policy analyst here in Bloomberg Intelligence in the Washington D.C. Bureau. And we just want to extend also a welcome to our listeners coming to us from the Balance of Power podcast. As I've said before in this call is also going to be included on the Monday edition of the Balance of Power podcast. So certainly for those folks who are listening to us from that vehicle, if you'd like to attend these calls, which take place Mondays at 10 a.m., please feel free to reach out to me at ndean10@bloomberg.net, and we'll make sure that you have the invite for that call. So first, let's talk government shutdown. We have 11 legislative days until September 30th. It's not a lot of time until the government is scheduled to shut down. As a reminder, the U.S. fiscal year goes through October 1st. Now, I've said before in this call, and I'll say it again, that I think we're at a 40% chance of a shutdown, and that's fairly high for me. If you've covered shutdowns with me in the past, you know that I rarely ever get above 25 or 30%, but I'm a little bit higher right now because of the amount of the political rhetoric that we're seeing coming out of both the White House and Congress. But let me explain why I don't think that there is going to be a government shutdown. And I should also preface by saying that pretty much no shutdowns that we've looked at have much of an impact on markets or on companies. There tend to be some headline risk associated with government shutdowns. You'll see a lot of scary headlines, but from the market's perspective, there really is no impact. So why do I think there's not going to be a shutdown? Well, look, when it comes to the Republicans want to extend the government, and they do not want a shutdown. They certainly don't want a shutdown in an election year, and President Trump has said that he would prefer a one-year CR to get this passed, or at least close to the election of next year, because there is never going to be a government shutdown 30 days before an election. And so you are seeing language from the Republicans saying that they would like to kick the can potentially up to a year to try and push this off and to have additional time to work out appropriations bills. I don't think many appropriations bills are going to pass. I think the NDAA is one, but I don't think many of them are going to pass. And as a result, I think a continuing resolution most likely in December is the most likely outcome here. From the Democratic perspective, it's a little bit trickier because a lot of the folks on the progressive side want to be seen fighting President Trump. But the question that I often ask myself is that, okay, if you get into a situation where the government is shutting down and you potentially could take the blame for this, what is the end game and what is the strategy here to try and win votes in 2026? And even though it may be popular for progressives to be seen fighting President Trump, when it comes to Senate Minority Leader Chuck Schumer or House Minority Leader Hakeem Jeffries, who are trying to reach out to also independent voters, a shutdown may not be the best thing, especially as you're trying to build momentum into 2026. Now, look, I don't think anybody's going to go into the voting vote in November of next year and say, look, I'm going to vote a certain way because of what happened in the government shutdown fight of September of 2025, but it's all about momentum. And the other thing that's keeping, I think, the Democrats a little bit of pause in terms of shutting the government down is because of OMB Director Russ Vought. Now, former OMB Director Mick Mulvaney came on Bloomberg Television last week, and he was actually talking about how he wished that he was Russ Vought and that he wished that he was in this situation because of the power that the OMB has. The OMB is the one that would decide which government workers are essential and which ones are non-essential. And if we get into a scenario where Director Vought says, look, I'm going to say 90% of the U.S. government is not essential, they all can go home, and let's see if we can work with the government shutdown for 3 to 4 months. I mean, there have been folks on the Republican side in the past who said, look, let's have a government shutdown and let's just see what happens, because, you know, you could get into a situation where 85 or 90% of the government workers go home and they may not come back. So I think from the Democratic point of view is that, yes, they would like to be seen fighting President Trump, but ultimately I don't see where there's an end game here where it works out. Shutdowns occur when the party thinks that it's politically advantageous to themselves. And if you get an extension into December, then you always have another time or another bite at the apple to have a shutdown. I would also just say when it comes to government shutdowns, keep an eye out for must-pass pieces of legislation. You may have heard me talk about this in the past, and in this case, in this scenario, I think it's Senator Durbin and Senator Marshall's Credit Card Competition Act. What happens is that when folks, they call them Christmas tree bills, because you hang this bill on a tree, meaning you hang this piece of legislation on another piece of legislation and bypass regular order and use that legislation to get it to the president's desk. In this case, I think what would happen is, don't be surprised if Senator Marshall comes out there and says, look, at the last minute, I'm going to try and attach my Credit Card Competition Act to the government shutdown extension, the continuing resolution, and see if I can get a way to pass it. Because, look, it makes things a little bit more difficult. And long story short, and maybe this may be too long, but if you go back to the early days of Dodd-Frank, we had a situation where there was a government shutdown right before the holidays. And President Obama at the time was trying to figure out, do I have a government shutdown? He was negotiating with the Republican House. And a couple of folks on the Republican side said, look, why don't we attach as a Christmas tree bill a repeal of the swaps push-out provision of Dodd-Frank? Now, you remember back at the time, this was a provision that required these investment banks to push their swaps away from their FDIC-insured affiliates. And so the Republicans attached it to a government shutting bill, or a government continuing resolution. They sent it to the president's desk. The House passed it, and they all left town. And they all said, President Obama, fine, we've left town. So you can either sign this and repeal the swaps push-out provision, or you can shut the government down, and we'll have this fight in December or in January, and you potentially could take the political blame. And President Obama was backed into a political back corner, and he ultimately signed the deal. And as a result, the swaps push-out provision of Dodd-Frank is no more. Now, this tactic is well known. Everybody on both sides of the aisle knows this tactic. But when you get into these situations right around 13, 12, 11 days in advance, keep your eyes out, because that's what could potentially occur. And when it comes to this Credit Card Competition Act, if you've flown through LaGuardia or Newark or Dulles, you've seen the ads, that this would create more competition for Visa and MasterCard. The banks don't like this, and the airlines certainly don't like this, but the retailers would. So a couple other things that you're going to see this week. You're going to see the Senate change the rules on nominees. John Thune, the majority leader in the Senate, just said today that they're going to be doing this. They're going to change sort of the nomination rules and the timing of when they can put nominees through. It's going to make it much faster for Republicans to speed up its nomination process and get a lot more of President Trump's folks into their positions. Same thing will happen if the Democrats control the House or the Senate and the presidency in the future. So it's really not much of a dramatic change here. But I would just say is that I don't think this is going to impact the government shutdown fight all that much. Other things going on. Well, last Friday, the Senate Banking Committee released an updated version of the crypto bill. This is the Responsible Financial Innovation Act. This is the Senate version of the Clarity Act, which we've talked about on this call before. And I should also note that this is the Senate banking version of it. We're still awaiting the Senate ag version of it. The real big differences between what the Senate Banking Committee released on Friday versus what they released previously is that they included a little bit more language about the Commodity Futures Trading Commission, asking the SEC and the CFTC to come together and actually write joint rules on how they will manage crypto. A lot of the Senate ag language that we're anticipating later is going to be dealing with this, so I don't think it's going to really change things all that much. And I'm still at a 70% chance that this bill can pass in the beginning of next year. The Senate Banking Committee is hoping to get this out of committee by the end of this month. We'll see what happens with the government shutdown. Maybe they have that committee or not. I don't know. But I do think a couple of Democrats will eventually go with this, and I think come early next year they'll be able to get this done. A couple of things on the regulatory side that I want to talk about. First, on private funds, I put out a piece of research last week talking about what the SEC could do in terms of enhancing private markets. We've talked about the Department of Labor's 401k changes on this call before. This is where President Trump released an executive order ordering 401k providers to be able to include alternative investments like private equity or also crypto. We're still waiting on the Department of Labor to move forward on a proposal on that. But from the SEC perspective, I also anticipate the SEC sometimes over the next 6 to 9, 12 months to start looking at things like Regulation A, Regulation crowdfunding, changes to the accredited investor definition. It's not going to dramatically change assets under management for the private equity folks or the alternative asset managers, more likely. But I definitely keep an eye on this because I wouldn't call this a top priority for the SEC, but certainly keep an eye on this over the next 6 to 12 months. And for what it's worth on the SEC, and I should say for all the regulators, just last week they released their regulatory agendas. I'm not sure if many people know this, but twice a year, all the agencies in the federal government, from the SEC to the Farm Bureau to the Federal Reserve, they release what's called their regulatory agendas, and they list out all the rules that they're contemplating or they're considering. Now, in the funny space is that pretty much all of the SEC's rules say that they're going to move on it by April of 2026. They just put that date because they really don't know when they're going to move on it, and they're never held to it. But it does give you an indication of which rules they're considering. And in the SEC's case, they had two rules. They had one just called crypto rules, very broad, I know, and the second one they called crypto market structure, again, very broad. But the private fund aspect of it was more so, I think, a second tier, so you'd see that towards the end of 2026. Things like disclosures, executive compensation disclosures, and so forth. So I'm going to be going through those regulatory agendas this week. So if you have any questions on that, just feel free to reach out and I'll talk about that. Last thing on the regulatory front is we read through most of the comment letters, or at least most of the key comment letters, when it came to the Fed's proposal on the enhanced supplementary leverage ratio. This is the ESLR. So if you're looking at the big banks, if you're looking like a Bank of America or JP Morgan, currently the ESLR is required to be at a 5% leverage ratio. This would drop it to 3% plus 50% of a GSIB surcharge. So you're looking at around 3.5% to 4.4% depending on the bank. Now, I read most of the comment letters, and I really had three themes from these comment letters as we think what the Fed's going to do. The first one is most of the market participants were comfortable with this idea of going from 5% to 3% plus a 50% GSIB surcharge. There wasn't much discord over that. The main question was, what do we do from treasuries from the denominator? Because you recall, Secretary Bessent has said that the ESLR is a restriction on treasuries, and there's been a lot of ideas out there to exclude treasuries from the ESLR. And 18 months ago, I thought it was going to happen. But instead, the proposal came out and did not exclude treasuries from the ESLR. And instead, these market participants said in these letters, and I'm paraphrasing here, we wish that the regulators would just reaffirm their ability to exclude treasuries from the denominator of the ESLR in times of stress, aka if we get into another situation like we did during the COVID pandemic and the Fed says, look, you can just exclude treasuries from the ESLR and you're good to go, as long as the regulators reaffirm that they have that right, I think the market participants will be fine. And then the last thing was somewhat interesting is a lot of folks were actually asking for changes to the long-term debt and to the TLAC rules. If you go back to some of the calls that we had almost a year ago, the Office of the Comptroller of the Currency had a proposal on retail or long-term debt for regional banks. I think that's gone. I think these letters were geared towards more of like asking the OCC to officially rescind that proposal rather than keeping it on the books. And then changes the TLAC. I don't think it's coming anytime soon unless it's small, minor changes. We've talked about what the Feds are going to do on bank capital before. And so Basel III Endgame, GSIB surcharge, stress capital buffer, stress testing, and so forth. And just for what it's worth, I think a couple of those proposals from the Fed could be out as soon as next week or the week after, so my spidey sense is tingling on that. The last two things are more on the geopolitical front. President Trump just said over the weekend that he's not happy with Russia and his patience is running thin. Again, my words, I'm paraphrasing here, over Russia-Ukraine negotiations. As a result, I'm going to be looking for language coming from Senator Lindsey Graham to potentially move forward his Russian sanctions bill. This is the bill that would allow the president as a tool to implement up to at least 500% tariffs on countries that purchase Russian oil, including Russia, but other countries like China, Turkey, India, and Brazil. So again, my spidey sense is tingling on this one, so look for headlines to start popping up next week or maybe even this week on it. And then finally, it happened on Friday night, but in response to some of the EU fines that Google and rest of the technology sector has been talking about, President Trump threatened a Section 301 investigation on Europe for that. So we're waiting to see if we get any more headwinds out of that later this week. So I'm going to stop there. I'm going to say thank you very much for attending. We always appreciate it. Thank you for listening, and we wish you a great week. Thank you.
Our thanks to Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, bringing you the latest installment of his weekly Washington Policy Pulse. For more from BI or to join this call live each week, you can email Nathan at ndean@bloomberg.net. That's NDEAN@bloomberg.net. And come back to the podcast later today for the latest edition of Balance of Power.